Hello, welcome everyone. Welcome back to another video. Today I want to talk about what's been making the rounds, the 50-year mortgage, and what we can actually, and will it actually help anybody? And is there any other ways? So I have my, 5 ways that I'm really pushing how we can help with the affordability. So the whole point of the 50-year mortgage that the Trump administration is pushing out is to help lower payments. That's their agenda, is to lower payments, because they know as well as everybody that's in the profession knows it's not really going to help with lowering prices of homes. It's going to be more of lowering the payments of homes. So let's start today with, let me go over the interest rate. So today, happy Thursday. Today is November 13th. And let's pull up these interest rates for today. So today you're looking at 30-year fixed is sitting at 6.3%, 15 years at 5.8, and you have your 30-year FHA, which is at 6.03. So it is a little bit higher than prior in the prior weeks. We saw in the beginning of October is when we had the best period. It was like 5.99, 5.8, and then as we got that rate cut at the end of October, we saw the rates jump right back up, which was anticipated. This was if you look back into my older videos, I've been posting about this, that this was anticipated, this rate hike coming in. So now that we got the rate cut out of the way, however, the curveball was when the Fed chairman did do his meeting, and he was speaking, and he said the December rate cut is undecided, or is highly unlikely that it might happen or it might not happen. So that kind of was the curveball in the markets. It kind of took the markets down. Everything started to pull back. Rates started to go up. The bonds started to increase in price. So, him just saying that hey, we might not do a rate cut in December coming up really spooked everyone, and which caused the rates to go up. But again, we had anticipated the rates to go up after the rate cut happened in October. And from the way I see it and what history has told us, we should be seeing rates coming back down to the 6% mark by the end of this year. So we should be ending the year in the high fives, 5.99, around 6.1, 6.2, right around there, which is still better than 12 months ago, where we were 12 months ago. Because 12 months ago, let me pull this up, last year at this time, I'll tell you right now, we were at around 6.63%, and we ended the year at 6.8%. So we are still going to be over 0.5% or 50 basis points better than where we ended 12 months ago. So we are getting improvements on the interest rates, and the rate cuts have been helping with the spreads. If you know that the spreads is what the banks make on, so they'll borrow the money from the federal government at the current prices, which is around 4 to 4.25%, and then they add their profit margin on top, which is called the spread. Then they lend it out to the consumer. That's where you see 6.3 today. So the spread is around 230 basis points or so. So the spread's been getting better, which is helping with the interest rates coming lower. So we're hoping by the end of the year that the spread continues to get better. And if we get that December rate cut, then we should definitely see 6% interest rates. And I think we're going to be holding on to that going into 2026. We'll hold on to the 6% interest rate. And hopefully by mid 2026, we should start seeing 5 3/4, 5.75, 5.8, 5.6 being the norm in interest rates on a 30-year fix. Now, talking about 30-year fix, Trump's administration, Pulte, I'll tell you right now, they're proposing a 50-year mortgage. So that's another jump up from 30. So right now we have 15, we have 30, and now they're proposing a 50-year mortgage. Now, a 50-year mortgage doesn't make a lot of sense in a way. So remember, they're not replacing it. So they're not going to replace the 30-year with the 50-year, which is the good part, because the 30-year it's still okay, but the 50-year, it's not much big of a difference in the mortgage payment. So on an average home of $400,000 with 20% down at a 6% interest rate, you're gonna save anywhere between $100 and $200 a month going from 30 and choosing a 50-year mortgage. Because also remember, a 50-year mortgage will come with a higher interest rate as well, rather than a 30-year mortgage. So you'll have the higher interest rate. You're probably gonna have to pay a little bit more in fees, but you're definitely paying more in interest overall in the entire term of the loan. So which I don't anticipate anybody taking 50 years to pay off a loan. A very small portion of people, I mean, even where we are today at 30-year mortgages, only about 2% of borrowers that take out a 30-year loan end up keeping the loan for a full 30 years and paying it off. Most, on average, most individuals, most borrowers, they either refinance the property, they sell the property, or they completely pay off the property, and the average is around 12.8 years. So now the 50-year will only make sense. So now when I'm sitting with a client and I'm discussing with them if this option does become available to the markets, I'll go over the numbers with them, and that's difference it's not that significant in the mortgage payment. And I think ultimately people still settle on the 30-year rather than the 50, just because you'll have that interest rate play that will come in, and then you'll be paying a higher interest rate as well, and an APR to get a 50 instead of a 30. So you'll have these things that'll kick in that will ultimately just bring all the borrowers back to 30 or 15, because they'll just make more sense in the long run. However, the 50 might be beneficial for certain people that maybe they're just off by $100 to qualify for a loan for the 30-year, for their dream home, or whatever home they're looking at, or the neighborhood, the price tag, whatever it might be. So it's going to be such a niche market for that 50-year loan. I just think introducing it there's no harm in introducing it, having it available. It doesn't mean that you as a borrower need to go forward and select it. So it's not going to be mandatory to go ahead with the 50-year. So they can come out with a 100-year, 150-year, it doesn't matter. At the end of the day, what matters are the numbers. You got to sit down with your professional, whether that's your real estate professional, or if you're sitting with me and my team, or your loan officer, whoever, your accountant, whoever you're sitting with, you got to run the numbers. You got to make sure that those numbers make sense. And you do the comparison between 15-year, 30-year, and a 50-year, and see which one you're going to go with. I don't think a lot of people are going to be taking the 50-year option. I think a lot of people will still stick with the 30-year option, and then take it from there. Because also know with the 50-year, is typically if you take the entire 50 years to pay off the loan, you're going to be paying roughly 2.5 times your original principal amount and interest, which is a lot. Right now with a 30-year, you're paying roughly 2 times, 1.5 to 2 times the principal amount. So you got to make sure, like, in 50 years, you anticipate if you buy a house today, in order to break even, your house is almost tripled in value, basically, in order to break even. So I don't think a lot of people are going to take the 50-year. I think they'll stick with the 30. However, because the Trump administration and everybody else is on this affordability time horizon, like, hey, we want to make housing affordable. So because everybody's on this affordability thing, I think there's a lot better ways. There's much better ways and ideas to implement that will allow affordability to exist in the housing market and maybe help it better. So here's a couple of things that I think. I think we need all government-backed mortgages to become assumable. So right now, for majority of mortgages, when you're closing on your property and you get the closing documents, you'll see it says not assumable on one of the pages, that the note is not assumable. Now, what assumable means is, let's say I'm the seller and I have a 3% interest rate and I'm selling my home, and the buyer coming in, the buyer, right now, the way it works, the buyer has to get their own mortgage. They'll get the interest rate that's offered to them today on the market, et cetera, the whole process. Now, with assumable, me as the seller, I'm able to give the new buyer my mortgage with the mortgage. They'll just take over my mortgage. That's basically what'll happen. So they can take over the 3% interest rate. So now if I'm selling my house for $600,000 with a 3% interest rate, the new buyer coming in can just take over my mortgage at 3%, qualify for it, and they just take it over, and the bank just pays me as the seller out whatever my net proceeds are, which is pretty amazing. Now, the way this would work is it's like a transfer of mortgage from from me as a seller to the buyer. Now, if the house is worth, let's say, 600,000, but I only owe 300,000 to the bank, now that buyer would have to cover that 300,000 difference. So if I have it listed for sale at $600,000, the buyer needs to give me 300,000 upfront, and then they would assume my $300,000 mortgage. So it's the same thing as me if I was to put it on the market for 600 and the buyer came in, they got their own mortgage, and then the bank went ahead and cleared my $300,000 debt and then gave back my net proceeds of 300. So this way, it's more of capital issue than it would be of anything else. But this can open up more inventory and bring it to the market, because a lot of homeowners are stuck because of the 2.5%, 3.5%, even up to 4% interest rate. They just, unless you're in a dire situation, you're not looking to get out of your house, just because it's a lot cheaper to stay in your home rather than renting. The mortgage is dirt cheap compared to what you're going to get on the market. And so unless like life circumstances are forcing you to sell and move, you're staying in your home. Also, most homeowners are just like, hey, we can just rent our house just because we'll get more rent than the mortgage payment because of our low interest rate, and then go ahead and purchase something else or go move somewhere else, whatever they have to do. So this will definitely open up a lot more inventory. However, the buyer market will be very niche, because you're going to have buyers that have a lot of capital to come in to assume these mortgages. So they'll get a very good deal on the interest rate. If the rates stay at 5%, 5.5%, a buyer coming in can pick up a 3%, 2.5% interest rate loan from the seller, and I mean they've struck gold on that. And then also the bank doesn't have nothing happens with the bank, because the bank is still, their risk is not so high still. Their debt to loan value is only the loan, the loan value is going to be like 50%, 40%, 60%, whatever it might be. So the bank at the same time knows. I think you went out. There we go. So the bank also knows that, look, this person can take over the loan. The value of the house is there. If they stop making the payments, we have to foreclose. At least we have equity in the property. So assumable mortgages need to change this, and it's as easy as just, they just have to figure out the numbers. Obviously, it's not that easy, but they have to figure out the numbers in the back end, and then just send a document to all borrowers and say your loan is now going to be assumable. If you agree, sign and send it to us. Number two is capital gains exemption on primary residences. So it's very important. Primary residence right now, as we stand, if you sell your home after owning it for 2 years as a primary residency, if you're single, you're exempt up to $250,000 in capital gains, and if you're married, it's up to $500,000. So what that means is, if you bought a house 5 years ago, 10 years ago, and today you're selling, and a profit of $250,000, less than $250,000 as a single individual, capital gains is on that income. And if you're making less than up to $500,000 as a married couple, then you're exempt from capital gains tax on that. However, anything past those limits, you have to pay capital gains tax, which I think right now we stand at like somewhere like 40% take. So if we were to increase these numbers, because remember when these laws were made with these capital gains many years ago, when house prices are a lot lower than what they are today. So I think we need to increase the capital gains exemption to, let's say, $1 million for married couple and $500,000 for a single person. This will also help, because it's another boundary, another place where people are stuck, where they're like, okay, I bought in 2020, the value of my house has gone up, I want to sell, but man, I'm going to be stuck with this massive tax bill. And then, when you do the math on how much taxes you have to pay compared to what you're going to take out because you're trying to buy something else, or whatever you're trying to do with the funds, mathematically, it might just not make any sense. So you're like, you know what, I'm just going to sit on my house and that's it. So increasing the capital gains tax, again, this isn't for like, a majority of the market, but definitely a good amount of the market will open up if we just have this one capital gains exemption in place. Now, in terms of affordability, to help with the home mortgage payment per month. So one, obviously, everybody knows you lower the interest rate, the home mortgage payment goes cheaper. However, there's a side effect to that where if you lower the rates, the home prices will go up, and essentially the savings gets eroded away, because if the price goes up and now you're buying a house that's, an additional $50,000-$60,000 just because the rates went down, you pretty much come back to the same mortgage payment, in the same ballpark. It won't be the exact same, but it'll be in the same ballpark. So those kind of savings erode away with interest rates coming down and then house prices going up. So in order to combat this, there's two things that we can get. We can get property tax reduction or removal on primary residences. So I'm not talking about investment properties. I'm talking about where an owner buys, you're a buyer, you're buying a house as a primary. I completely believe in getting rid of primary property taxes. So no property tax on a primary residency. This will eliminate anywhere between, I know here in New York City, this will eliminate anywhere between 500 upwards to 1,000 a month from your mortgage payment. Like, it'll just take it away if you get rid of primary property taxes on primary residence homes. Or you can give special discounts. Maybe if you're a first responder, you're public, your government employee, teacher, and it could be numerous different types of ideas. But if we can reduce the property tax, at least start there before we remove it completely, and see how that works out. And then maybe the government can figure out how else to fund their programs right now that they're using with property taxes. And let's reduce the property tax, see where else we can fund. And once we have a solid ground, then we can completely eliminate property taxes from primary residencies. And you can offset those taxes by, maybe a little increase, 2 to 5% on investment properties. So this way, because investment properties can eventually just, recuperate those over time, and then also they're allowed to deduct those taxes off the P&Ls for those investors. So on primary residency, definitely the property tax is going to help. Then the second thing is home insurance. Home insurance has been we've seen the highest home insurance increases in record time since COVID to today. I think home insurances have gone up almost 2 to 2.5 times the amount, which is insane. And I know my clients, when I first, back in 2021, when I was selling homes at that time, we were getting home policies on single family homes in New York City around $900, $1,100 a month. Today, we're sitting at $2,500 to $3,000. So it's gone up almost 2.5 times the amount. So definitely the government needs to step in, figure something out with this home insurance stuff, because it really eats away into borrowers' monthly payments. And everything can help because the rates went up, so more interest has been going to the bank. But at the same time, taxes got up, home insurances went up, so that everything piled in together. It wasn't just one item and then the other item came after a few years. It was everything at once, which really just rose home prices, mortgage payments astronomically. So we definitely need to tackle home insurance premiums and bring them back down. I don't really know exactly the back ends of how home insurance policies work and everything. However, I'm pretty sure they can figure something out where they can get a reduction. You haven't done a claim, maybe safety, you have cameras, you're linked with your local police department, like all these different things, and give good amount of discounts, and make sure your home is fireproof to a certain extent, you have sprinkler system, all these things, and really bring those policies down in price. And lastly, I think your mortgage should be portable. So this is actually something the Trump administration just put out after the 50-year, and I'm glad that they're taking this stance, because a lot of real estate professionals, including myself, want this. And I just think this just makes sense in 2025. This just makes sense to do in today's day and age, because what this means is, let's say today you have a 4% mortgage, 3, whatever your rate is, and you want to move it to another property, you should be able to sell your current loan, sell your property, but keep your current loan and transfer it to another property. So you don't lose your interest rate. You save a ton of money on fees. And so you don't have to pay all those closing costs all over again, with the banks and points and all of that stuff. So you'll save time, you'll save money, and less paperwork. And you can just transfer your current mortgage and take it with you to the next property and just, whether it's more money or not, then you can work with your bank and your loan officer to figure out how you can qualify for more money, how you can, or if the house is cheaper, if you're downsizing and your current loan maybe the current the house that you're selling, then it can pay it off. So it's like it's all intricate. It's a very complicated process. But I think if we can figure out a way to make mortgages portable, I think that'll really help in the long run. And again, this is not, all of these items are going to be like, everything's not going to work for everybody. Everybody's situation is going to be different. You're a first-time buyer. You care more about the interest rate, the monthly mortgage payment, what the taxes are, what the insurance are. You're a current owner. You're looking to upgrade your home. Maybe your family's gotten bigger. You're moving to a different area. You want to make a bigger home. Then the portable mortgage is going to make sense for you. You're a seller. You're downsizing, and you have a great interest rate. And a buyer comes in, and you want to try, because what's assumable mortgages is the people with 2%, 2.5%, 3% interest rates. You can actually ask for a little bit more money on your house just because it's so attractive, because in the long run, the buyer is just going to end up saving so much more money on that house by taking over your loan. So if you have a 2.5%, 3% rate in a market where a house is selling for $600,000, you can actually get $620 then, just because of that little bit of premium you'll receive for having that great interest rate. So if you're a seller, you might want to go that route of saying, hey, take over my mortgage. I'm out, give me my money. I got to downgrade, or I'm moving away somewhere else and I just need the cash and I'm done. Or you're moving into renting, whatever it might be. So all of these different options that I laid out are going to be, not going to fit for everybody, but it's going to be different for every single person. So as we move forward, I'm really hoping that they really change this mortgage game, because it's been the same for, beginning of time since mortgages existed. So they really need to improve in the offerings of mortgages, make them assumable. And controversially, last but not least, I honestly think that we should bring back ARM mortgages. I think ARM mortgages in high interest rate environments like today really make sense. So an ARM mortgage, if you don't know what it is, I'll quickly tell you. It's basically when you take out a loan, it's something called a 5-1 or 7-1. So meaning you lock in an interest rate at a discounted price. So if today's interest rate is 6, you'll lock it in at 5.5 for 5 years. That's what 5 stands for, /1. Then after the 5 years is over, every 12 months, your interest rate will update. So whatever the interest rate is at the time when those 12 months are up is, so if it's 5%, then your loan will drop down to 5. But if it's 7, then it'll go up the next year. However, that doesn't stop you from refinancing. So on the 4th year, if the rates have dropped down to 4%, you can go ahead and refinance and lock in a 30 years. So I really think mortgages should also make a comeback. I think they're really good, and especially in high interest rate environments, they're really good because they let borrowers take a loan at a discounted price on the interest rate, betting basically that, hey, in 5 years or 7 years, whatever the term for that ARM is going to be, the rates within that time period will go lower, and we'll just end up refinancing and locking in a 30-year fix when it does. And in the beginning, it puts a little less of a burden on them from getting a discount on that interest rate, saving money on interest over there. So those are just my ideas. I put them in the description. You guys can check out. Please share this video with anybody you think that wants to know about 50-year mortgages, or how mortgages can become more affordable in the future. Let me know what you guys think in the comments below. If there's any want me to discuss, and I'll come back live and we'll go over whatever. There's a lot happening this week with the government reopening and everything. So right now it's too early to tell. With the interest rate didn't really have a movement after the government reopened. So let's see where it goes by tomorrow. And I'll try to come back on tomorrow evening and wrap up the week. Thank you for watching, guys. I'll see you on the next one.